Okay, we will make a start for all of you here. Tēnā koutou katoa. I'm Sarah. I'm from Hikapapa Hononga, and I'm going to be hosting today. So welcome to the first talk of the year that we're hosting. Today we have a talk by Ivan Diaz-Rainey titled Are Investors Taking Charge of Climate Policy? Climate Finance Research at the University of Otago and Beyond. Dr. Ivan Diaz-Rainey is Director of the Climate and Energy Finance Group and Associate Professor of Finance at the University of Otago. He is Associate Editor of the Journal of Financial Regulation and Compliance and has previously held academic positions in the UK, Abu Dhabi and Italy. He has conducted research, policy and consultancy work for the ADBI, OECD, EON UK and ECMI. His research has been published in leading journals including Climatic Change, Energy Economics and the Energy Journal. His current research interests include financial regulation and climate, carbon and energy finance. Ivan will give his talk and then there'll be opportunity for questions. If you have a question, could you please either put your hand up using the Zoom mechanism so I can see, or private message me, which is probably easiest. I've got the wee chat thing going at the moment. Hi to those of you saying hello. And at the end, I will ask Ivan the questions on behalf of you. So many thanks, and over to you, Ivan.
Thank you very much. Kia ora, everybody. Thank you very much for coming along. I'm impressed how many people are out there. So thank you very much for coming along. Just to be clear, I have an hour, is it in total? Sarah?
Yes.
Yeah. Okay.
Yeah.
So I'll try.
We've got an hour for the whole thing, so
yeah, I'll try and keep my comments to about 50 minutes to allow for 10 minutes of questions. So so I presume you can all see my screen. Is that correct, Sarah?
Yes, I can see your screen. Thanks. Yeah.
Okay. So I guess for a climate audience, the title is a little bit provocative. Are investors taking charge of climate change? Actually, for those of you that read Nature Climate Change, there was a paper with that exact title that came out a few years ago. And so what I really aim to do here is three things. So I'll give you a sense of what's happening in the investment world and the initiatives that are going on in terms of incorporating climate considerations into investment, but also the risk side. So there's really two sides to this. There's an investment opportunity and there's a risk side of it. There is a whole lot going on. And if there's anything good to come out of COVID from a personal perspective is that I'm not totally inundated with climate finance stuff. The issue was really taking off at an incredible rate, and it was very hard to keep up with all the initiatives that investors were pursuing in this area. It's very easy to be cynical about some of these initiatives, and I think early on some cynicism was well placed, but increasingly we're seeing what I would say is a real seriousness from investors around the issues of climate change. I think that's because they realize it's going to affect the bottom line. It's not necessarily out of altruism, but just a realization that actually climate change is real. It's having a material impact now on financial returns. So, you know, to give you a sense of what's happening, you know, there's a whole load of groups like IPCC, which is the Institutional Investors Group on Climate Change. You know, this is a grouping of institutional investors, so really pension fund managers or sovereign wealth funds that manage trillions of dollars of assets around the world, and that they say they're going to align their interests to climate change. We have a group of regulators in the face of the Task Force for Climate-Related Financial Disclosure, which is part of the Financial Stability Board. They have been doing work on this. You've got UNPRI, and I'll talk more about those. You've got the One Planet Sovereign Wealth Funds, which our own NZ Super is part of. And I was recently, or at the beginning of this year, in Paris at a meeting of this grouping. They manage 3 trillion worth of US dollars in assets, and they're committed to aligning their investments that in a way that's consistent with tackling climate change. And in New Zealand, we've got the Aotearoa Circle, which is has a sustainable finance initiative. I'm on the technical working group on that, and that's looking at it from a New Zealand perspective. So there really is an alphabet soup of initiatives and groups emerging around finance and climate change. I'll also talk about how we've responded at the University of Otago, and that's tied also to our membership of something called GRASFI, which is a Global Research Alliance for Sustainable Finance and Investment. That's headed out of Oxford, and at Otago we're one of the founding groups of GRASFI, and in response to our GRASFI membership, we've set up this climate and energy finance group, CEFGroup. And really, we're one of the largest climate finance groupings in the world, and I'll talk a little bit about our strategic positioning. And finally, I'll talk a little bit about COVID and how that's affecting clean finance and in particular oil markets and energy markets, and what implications it might have for energy transition. So when I present this to a finance audience, I sometimes have to explain about climate change, but I think most of the audience will probably come from a deep understanding of climate change. But we're seeing real material impacts now of climate change and flowing through to the financial sector. So with the fires that they had in the US. Back in 2018, PG&E filed for bankruptcy, and the CEO blames climate change. So climate change is having a real impact on financial markets. To be honest, I used to work at the University of East Anglia, and 20 years ago, the insurance industry was very aware of climate change, and they were one of the major funders at the university, in particular. In their actuarial science, they wanted to see how climate change was going to affect insurance. Insurance industry has always understood risks of climate change very well, but now increasingly you're seeing other groups of investors becoming aware. But there's a wide divergence of understanding of climate change issues. So we're seeing real and material impacts now on financial markets. Again, this is from the 2018 IPCC report, and this gives us an illustration of what we need to do. And if we could see the curve to the left-hand side here, we would see that emissions have just been growing, and we really need to turn that around. From a climate finance perspective, this really implies huge investment. And so I won't elaborate on that, but elaborate on turning the curve, but we know it involves a huge investment. And so, various people have tried to quantify the size of the investment needed. CERES, which is like a think tank, like a lobbying organization of institutional investors, that are concerned about climate change, in 2014 came up with this idea of a clean trillion. So we needed to be investing US $1 trillion a year per annum to tackle climate change. More recently, again in the IPCC 2018 report, they come up with a figure of 2.4 trillion. So whichever number you take, it's measured in the trillions. It's large, and these are annual amounts of investment that need to flow into the economy. And I think here, even the IPCC number is just on the energy system. So it's a very large number. It's interesting that the numbers there's such a wide divergence. I mind doing some exploration of more deeply into these numbers to try and understand why there might be such a big difference. But it's clear this creates a financing opportunity. And so to give you, those of you that are not from a finance perspective, a little bit of an important distinction here. So we talk about primary markets in finance and secondary markets. So primary markets, it's when a financial instrument is first issued, like a bond, like a share. And this is when the company or government first raises money. Then you have secondary markets, and this is what we see quoted on the stock exchange all the time. The financial product's been issued, and it's just being bought and sold. And so really what this, climate change creates a huge financing opportunity. We need to raise capital, whether it's bank finance, whether it's bonds, whether it's equity issuing new shares to finance energy transition. It's on the primary market. So there's a big opportunity there. On the secondary market, there are winners and losers. So, the transition towards net zero or decarbonizing the energy system, creates winners and losers. So, fossil fuel firms are ultimately going to lose, and, new energy companies, green energy companies are going to win. But the degree to which they're going to win really depends on the speed and nature of the transition. And so this is important in secondary markets. But the underlying point are these numbers, the 1 trillion and the 2.4 trillion. And let's take the IPCC as perhaps a more reliable number, at least for this presentation going forward. So we know we have these huge investment needs. So how much money has actually been going into markets at the moment, into energy transition, in particular investment in renewable energy. So this excludes energy efficiency. So it's not the full amount of investment. So if we say we need 2.4 trillion, we've actually been investing 280 billion in renewables. So, you'd add a few, maybe another 100 or 200 billion in terms of energy efficiency that's being invested. Maybe that's very high, but the key point is we're pretty far away from the 2.4 trillion. And so there is this funding gap. Yeah. Roughly, let's say we round it up, 400 trillion is being invested in investing in tackling climate change. If we were add energy efficiency, and I'm just pulling numbers out of the head, we know we've got 280 coming towards renewables, but it's pretty far away. So we need to scale up investment. So then this raises the question, does the money exist? Is there enough money to support 2.4 trillion per annum investing in tackling climate change? And the answer is, fortunately, yes. So, there's about 100 trillion of investment capital out there in the world. And so that's in investment funds. Actually, if you add bank debt, there's probably another 100 trillion. So there's enough capital out there. And even just taking investment funds that, ultimately the owners are ourselves through our pensions. If we take the 100 trillion and we take a return of 3% on that, that should be enough to generate the 2.4 trillion to invest per annum. So the money exists. And one of the things I would say is at these levels, and especially now given COVID, where government debt is going to go up through the roof, yes, a lot of that can be channeled towards a green recovery, but a lot of it will just go on social spending, on ensuring that people can pay their rent and so on. So governments are going to be even less in a position to support the transition. So, the emphasis on investors is going to be even larger. To put this 2.4 trillion into perspective, also, defense spending is 1.8 trillion globally per annum. If we take the 2.4 trillion to be the actual number, then even defense spending wouldn't cover it. So we really need investors at the table. And there is some good news. If you take, so this is the UN Principles of Responsible Investing. I'll show you what they are in the next slide. But what this chart shows is the number of investors and the amount of assets under management that they have signed up to the UNPRI. And so that means they're going to take ESG, environmental, social, and governance factors when they invest their money. Now, when you look at how many firms have signed up to the UNPRI, you take 2006, that was under 10 trillion. It is now around 90 trillion. So most of that 100 trillion is saying that they're going to take the environment into account when they invest. So that on the face of it is very good news, but we still have the shortfall. Yeah, so let's say it's a 300 billion being invested or 400 billion investing is still very far from the 2.4 trillion. So why is there this gap? Because we've got this chart showing that investors are keen to do it. So why is there a market failure? Okay, and I'll get into that, why that is. So a little bit more detail about UNPRI. So it's backed by the United Nations, and PRI stands for Principles of Responsible Investing. And it just says, I guess the key principles are at the top. And in particular, it says we will incorporate ESG issues into investment analysis. So we will incorporate environmental, social, and governance issues into investment decisions. So under the E part of ESG, they should really be considering climate change as they invest. And they will also be active owners. So I'll touch more on this when I look at some of the research that we're doing at CEFGroup, which is, when you're a shareholder, you have a vote at the annual general meeting. And so being active involves trying to persuade companies to change. Yeah. Some investors are just too big to be able to divest. So, if you're a State Street Global Advisors and you manage trillions of assets and you're measured against a benchmark, it's virtually impossible not to own certain stocks. So, your alternative is to be an activist investor and try to persuade companies to take into account environmental issues. So to sum up, we need about 2.4 trillion. There's 100 trillion, and just the return on that 100 trillion should be enough to meet that 2.4 trillion, but we're not there. We're probably investing anywhere between 300 billion to 400 billion in terms of tackling climate change. So we need to figure out why that is. And so what are the barriers to climate finance? So before I can really get into that, I probably need to explain a little bit more about what ESG is. So as I mentioned, it's taking the environment, social issues, and governance issues when you invest. Why have investors got interested in ESG? Well, client demand, and you're the client. You own pension funds, you own through the University Savings Scheme or through Kiwisaver, you have investments, and clients and ultimate asset owners have been demanding that institutional investors take environmental issues into account. It is in the literature associated in general with better investment performance when you take in ESG components. It's quite a contested literature, don't have time to go into it. But generally, ESG is associated with better investment performance, but again, it's a highly contested area. There are accusations that ESG is greenwashing, so selling new investment products to liberal greenies, and there's certainly concerns around that. But why are we not getting more money flowing to investment? And so here is where you have to understand the legal responsibilities that investors have. So this is a concept of fiduciary duty. So those of you that have studied a bit of law will be familiar. And so this is the sort of duty of care or of responsibility that investors have to protect your money. And so this is really done in your name. And so the interpretation of fiduciary duty in contemporary finance context is that when you invest in something, it must be liquid. So in general, in a portfolio, the largest proportion needs to be liquid. In other words, it can easily be bought and sold. So this means that a lot of investors don't invest directly in projects. Yeah, and if we think about energy transition or decarbonizing the economy, what we need to be doing is investing in products. So how can we overcome this issue? And it's a real barrier. And the other thing is not restricting the universe. So some of you may be aware of principle of modern portfolio theory. It's really the only free lunch there is in finance, where if you have a very wide universe, then you can generate better returns. But if you start restricting who you can invest in, the argument goes that you are going to limit returns. Actually, some of the ESG performance literature sort of debunks that. But you know, it's deeply tied in legal responsibilities. There have been reports in like the Freshfields report that tried to relook at fiduciary duty. In New Zealand, we've recently had a report as part of the Aotearoa Circle looking at fiduciary duty, not just of directors of companies, but of investors. The other thing is their funding gaps. So you have this market failure where investors want to invest, but they don't have enough products, liquid products that meet the requirements of fiduciary duties. And then you have this huge need to invest. So you really have a gap in the middle. So it is a really major market failure. And so one of the issues of addressing that is around fiduciary duty. The other issue is funding gaps, so feasibility analysis. So, you know, if you want to build a wind park, you need to do a feasibility analysis before investors will invest. And quite often there's a funding gap there in that feasibility. The other issue is expertise. So there's a very wide knowledge differential amongst investors on these issues. We have NZ Super in New Zealand, which is a driving force in the One Planet Sovereign Wealth Fund Forum, which is trying to get sovereign wealth funds to as I mentioned, align their investments with climate change. And then you have other investors that have very little knowledge on this issue. So there's a wide variety of investors, but investor expertise is an issue, but it's changing. It's changing quite rapidly. And this gets at, you know, curriculums, what we teach in finance curriculums and in finance professional qualifications as well. One of the ways to overcome this market failure is financial innovation, and actually a financial innovation that became, got a very bad name during the GFC, which was securitization. And really this allows the release of capital. So if someone invests in projects, they may not be a traditional investor, they may be a bank, and once that project is running, they can release that capital by turning those cash flows that come from the project into a bond and then sell it, and then the bank has new capital where it can invest in new projects. So securitization has huge potential here, but I think one of the reasons it's maybe been held back in this context is because it got such a bad name during the GFC. And then also we've got green bonds, which are rising in prominence over the recent years. So that's the funding. That's a funding opportunity. So that's, remember I said there was primary markets. So when a firm first issues a share or a bond or a loan is first made out, and the company actually gets cash, and that cash gets invested in a project, whether it's on energy efficiency, whether it's on solar, it's a solar park or a wind park or whatever it may be. Then we have secondary markets, and we need to think about, well, how are secondary markets going to be affected? So once a security is traded, how is the value of things going to be affected? And so Mark Carney, who is, or was still recently, actually, I'm not fully up to speed actually on, he's one of the most prominent central bankers. He was head of the Canadian Central Bank and then became head of the Bank of England, and he's been a really influential figure in raising awareness on climate change issues in the financial system. And he came up with this taxonomy, which classified financial risks in the climate risks, sorry, in the financial system as physical risk, transition risk, and liability risk. And so physical risk is fairly obvious. I mean, we obviously, in Aotearoa, we saw the effects of and in Dunedin in particular, we saw the effects of the Australian fires at the beginning of this year, where, you know, we had dark skies. Well, clearly these fires have had large impacts on the Australian financial system. The banks We'll have more bad debts as a result of farmers suffering from the fires and floods and so on. So I think most people from a climate perspective understand that these things have real financial impacts, and they're happening now. Transition risk is that winners and losers. So, you know, the sectoral repositioning, and so transition risk is driven by policy, technology, consumer preferences, but increasingly economics. I mean, wind energy and solar energy are now much more cost effective on an LCOE basis relative to conventional fossil fuels in most countries around the world, or in a lot of countries around the world. Another really important one, which maybe people are not so aware, is liability risk. So this is insurance claims. So we're aware of the insurance claims leading from physical risks. And of course, as I mentioned, insurance companies have been well aware of climate change and have been warning about climate change for at least 2 decades. Other parts of the financial system have been a lot slower. And so I think this is for people that, you know, don't come from a finance perspective and chastise finance for not doing anything. I think lumping the whole of finance in one category is not realistic, not refined to the large differences that exist in understanding climate risks amongst financial actors across different parts of the financial sectors, insurance, of the subsectors, but also amongst institutions. Some institutions are very aware, others are not. Another issue around liability risk is legal actions, and I'll talk a little bit more about that. So thinking of transition risks, we have winners and losers. This is a chart looking at when European countries will exit coal, and we see that most of them will have exited coal by 2030 and 2030. And so this clearly creates winners and losers. And interestingly, investors rely on forecasts. So when they value companies, they build models of discounted cash flows, and they need to project into the future what's going to happen. And so they need projections of what's going to happen to demand of products. Yeah, so whether it's consumer products or any product, they need real world forecasts or forecasts of what's going to happen to the underlying products that a firm sells. And I like this chart because it shows you know, how much uncertainty investors face in terms of the future. So these are forecasts by different agencies in terms of how many terawatt hours of electricity generation in the world will come from coal by 2050. And you look at the forecast by Bloomberg New Energy Finance versus Shell, the difference is massive. And so in a secondary market, if you're trying to value a coal company, then this makes it very problematic. To be honest, coal is probably not a great example, because it's clear the coal industry is dying, and you know, I think now we're starting to see the beginning of the end of the oil industry as well. Another good example around this is electric vehicle adoption, and so here's a 2016 forecast from various forecasters. So i.e. the International Energy Agency forecasted 23 million electric vehicles by 2030 in their 2016 forecast. By 2018, they'd raised that to 127 million. BP had a sort of similar sort of rise, estimating 72 million electric vehicles by 2035. They rose that, they increased that forecast in 2018 to 210. So even the fossil fuel dominant forecasters have increased their forecast of EV adoption. But we compare that, let's say, for OPEC. So this is the Oil Petroleum Exporting Council, which is the club of oil exporting countries that try to manage the oil price or fix it. Their forecast for 2040 increased from 46 million to 253. This tells you that, and this is important later on when I talk about COVID and the oil price war that's going on, tells you that even OPEC was expecting a huge increase in EVs. And so this was going to help really affect demand for their core product, which is oil. Yeah. But compare that to Bloomberg New Energy Finance, which is consistently the most optimistic forecaster. And, BNEF is forecasting, double of what OPEC is forecasting by 2040. And so, which number do investors believe? Actually, in general, BNEF has been much more accurate with its forecast in terms of wind deployment, solar deployment. So, there's a lot more uncertainty for investors, and it affects the value of companies and when you invest. Turning to litigation, so you're seeing a lot more climate-related litigation. You're seeing citizens suing governments, as in the famous case in the Netherlands, scientists suing lobby groups, but also those affected suing companies, NGOs suing companies, and regulators and investors suing companies. And we're seeing a huge rise of climate litigation around the world, in particular targeted at companies. Client Earth, there is one of our former graduates who's a graduate in law and finance, and he works for a firm, Client Earth. He's been to visit us once, and he's hopefully going to visit us again. And he's very interested in they're looking to expand in Asia, and you'll see that in my group we're doing work in Asia, and we're talking a lot to him around where climate risk is, and where what they tend to do is try and stop new fossil fuel plants being installed, and they've been pretty successful. So that takes me to the group that we've set up here at Otago. This is an image of our webpage, which you should visit. Just put CEFGroup Otago and you'll find it. We are one of the largest climate finance groupings. As I mentioned, we're part of GRASFI. GRASFI was set up by the Oxford Sustainable Finance Programme. They hired a couple of my PhDs over the years, and our invitation to that came as a result of that. We have at least 12 faculty, 10 PhD students. We're one of the things that differentiates us from a lot of climate finance groupings have come from social sciences, a more general social sciences background. Finance departments have been really slow to pick up on climate finance, and I actually wrote a paper about that. It's changing, so all of a sudden we've got all these special issues on climate finance. So that's mirroring what's happening in the real world, actually lagging what's happening in the real world. The real world, the real investment practitioners started taking this seriously some time back, maybe 4 or 5 years. Momentum started to really build it, and the academics are generally lagging that. So we come from a deep finance background, which is quite unusual. So for instance, the Oxford Centre grew out of their geography department, whereas we come from a finance perspective. We're very much practitioner oriented and interdisciplinary. We're working with geologists and climate scientists on various projects. We take a different view to most finance departments. We're willing to embrace innovative methodologies. Not really innovative. What most finance researchers just tend to focus on. It's a very empirical science. They won't do simulations, or they're very reluctant to do simulations or forward-looking stuff, which in terms of climate change is difficult. Or limits what the studies can generate. We also do some teaching. I've got a course at 400 level on climate and energy finance. I encourage you to look at our webpage. I'll give you a sense, let me check on the time. I'll give you a sense of some of the projects we're doing. So this is physical risk. We've been looking at South Dunedin, and increasingly we're looking at other areas, and how various flooding related hazards are going to affect house prices. NIWA and other Deep South have done national analysis. What we do is we drill down at a much more detailed level. So for instance, when is a property actually impacted? If there's flooding, if the garden gets flooded, does that affect the value, or does the actual property need to be flooded? The other thing with the national analysis, so what we do is complement the national analysis, but we go deeper. They use bathtub models. And what we've started to work with people like Simon Cox at GNS Sciences is to try and have models that are more geologically refined. We're also working with Greg Bedecker at Bedecker Scientific. So we're really trying to understand how house prices are going to be affected by climate change. Also taking into account that markets are forward-looking. So this is the other thing that people from outside finance don't always understand. Financial markets are looking forward, whether it's house prices or stock markets. They're very much forward-looking. And so, if your property is going to start flooding regularly in 5 years' time, well, markets are likely to adjust to that before that happens, if there is good information disclosure. Other work we're doing, so this involves Quinn Wynn, who's a PhD student. She is looking at climate risk in banks, and to do that, she actually used the first stage. Actually, I don't talk about this paper, but the first stage is using machine learning to forecast corporate carbon footprints, because only a subset of global firms report their carbon emissions. And then she used these forecasts and a loan level data set called DealScan to look at the exposure of banks, of US banks, to climate change. And here I show the sector exposure. And interestingly, US banks have basically sold out of coal. There's virtually no coal exposure in the syndicated loan portfolios of US banks. So, the idea that coal is dead from a bank perspective in the US, that's true. There's virtually no exposure. But very relevant to the current crisis, we see that banks have quite large exposures to oil and gas, and that's relevant to the shale revolution, and I'll come back to that in my conclusion, because I think with what's happening in oil markets at the moment, there's going to be a real impact on US banks, so there's going to be a spillover effect to US banks. Other work we're doing, so this involves Pia Helbing from the University of Leeds, who has this unique data sets of initial public offerings, IPOs. So this is when a market, so this is a primary market transaction. So when a firm first issues its shares in the stock market, and we look at brown energy and green energy IPOs. Actually, I'm doing a presentation of this next week for the International Association for Energy Economics. It's a webinar. Maybe I'll share that with the OCNET people, and they can share that round if you're interested in that. But what we see is a decline in brown IPOs, and more smart money going to green IPOs, and the people that founded the companies retain more of a stake in green IPOs. So it's all consistent with brown firms, oil and gas. Basically, the insiders selling out rather than investing in the future. So there is a realization that investors are moving on. I will also come back to this, because Pia has in the last couple of days done an analysis in the COVID context and the collapse of oil prices, how these firms have performed in the stock market, and unsurprisingly, green firms have outperformed brown firms. When we talked about liability risks, so we're doing work with colleagues in UC Davis and University of Seville, looking at how investors are putting in resolutions at the annual general meetings to try and persuade management to take climate change more seriously. And what we actually coded is these resolutions as disclosure related or risk related. And so disclosure is maybe disclose your carbon emissions. And so these tend to be quite light, whereas risk related ask questions like, how is your business strategy consistent with the Paris Agreement? And so these are much tougher questions for companies to argue. And we see that these risk-related resolutions go to vote. In other words, the firms don't settle them before the annual general meeting, and they get contested. And we see these risk resolutions becoming more prominent. And so this is one reason why I argue investors are taking this more seriously. With disclosure, there can be greenwash. Yeah, you can just say, hey, I'm going to disclose my scope 1 and scope 2 emissions. And disclosing scope 1 and scope 2 emissions is really in a company's interest because it's really about its own energy use. And every company should be, for cost reasons, looking to reduce their energy use. Risk-related disclosures, in other words, is your strategy consistent with the Paris Agreement? That's a lot harder. And so investors are increasingly asking those questions. Not, as I mentioned, for altruistic reasons, is because they realize that there's real potential material risk to financial returns. Other work that we've done for the Asian Development Bank Institute and in collaboration with Greg Seiss here of Energy Link, we've looked at green energy finance in Australia and New Zealand and compared the sort of money that's flowed in terms of green energy finance in the region. Actually, this has led on to a whole load of a couple of more projects. One, which is a working paper and a book chapter on ASEAN energy policy, which will be coming out very soon. Again, also with the Asian Development Bank. And also we've got a master student, Josh Morrison, working on climate risk in ASEAN energy utilities, doing interesting work that. The work that I've summarized for CEFGroup is just a microcosm of what we're doing. I haven't really talked, so the other principal investigator or someone who's got a strong track record in this area is Professor David Lant, who is a key member of our team. He's done a whole load of work on extreme heat and stock prices, various papers. So I haven't really focused too much on his work. We're looking at New Zealand's carbon market. We've got a new project going on there. So yeah, it's just a microcosm of what we're doing. We're doing a lot of work in this area. So let me sort of try and wrap up some of these themes and talk a little bit about the COVID, the oil price war, and greening the recovery. One of the things I would say is a bit like with technology. When we have new technology, we overstate the short-term impact, but we underestimate the long-term consequences. And I think crises are similar. And I think in terms of energy transition and the COVID crisis, I think this could be the case. I think some people hoping that nobody will go back to traveling once travel restrictions are over. I don't think that's going to happen. I think people are still going to be flying around. But in the long term, I think it has some really important consequences. And I think they can come in two dimensions. So the first dimension is greening the fiscal stimulus and infrastructure investment that comes. So whenever there's a major crisis, governments open the purse strings and start spending. Now you can do that in two ways that supports old polluting sectors, or you can do it in a way that helps to accelerate the transition. I was really pleased to see the proposal of high-speed electric rail as a potential way of doing this in New Zealand. I just see multiple benefits of exploring this. If you go to Scandinavia and you see their small countries do have very efficient rail networks, it's a good way to displace a lot of domestic air travel. And so, yeah, I think that's one example. I saw some tweets from people saying, how are we going to finance that? Well, in New Zealand, compared to other countries around the world, we have low debt. And so some credit to the administrations over the last 12 or 15 years for having government debt low, because now we are in a position to spend our way out of the economic recession that is already hitting us. The other thing that's overlooked by those saying, assuming that the government is going to finance this, is Kiwisaver. And actually New Zealand has a problem where Kiwisaver is creating a local pool of capital. We're all saving every month, every paycheck we get. And there really aren't that many places to park your money. So a little bit analogous to that problem that we have globally in terms of climate finance. So that their investors want to park their money, but the instruments aren't there where they can park their money that are consistent with these responsibilities they have with fiduciary duty. And so it's similar with Kiwisaver. If you look at our stock market, it looks highly overvalued, and that's because this, every month Kiwisaver providers get new flows of money, and they have to find places to park it, and a certain proportion of that is parked domestically, and we want it to stay domestically. We want it to underpin domestic investments and definitely green domestic investments. So this augurs at financial innovation, green funds, and again securitization to release project finance. And in this respect, Aotearoa Circle Sustainable Finance Program is doing a really important role. Another really interesting aspect of all this, so there's the opportunity investment side, is a sort of Schumpeterian creative destruction. And so we've had an oil price war. Actually, it's a market share war, which has been played out by price. So what happened with COVID was there was obviously a large demand in oil, but the elephant in the room is energy transition. So think back to those numbers I showed you in terms of expectation of EVs. Even OPEC was expecting a huge increase in EVs through to 2040. So initially in March, OPEC went to Russia, so OPEC Plus, to get an agreement in cutting production so that they could support oil prices. Russia didn't play game, and therefore Saudi basically said, okay, we're going to drop prices and try to gain market share. And it's almost like COVID triggered this realization that there was going to be oversupply. And, if those numbers on EVs are right, that's not going to get fixed even after we recover from the COVID crisis. And it could be that we've reached peak oil demand, and oil demand is just going to start going down indefinitely. So in that context, Saudi is the lowest cost producer. Russia also is a low cost producer. So they drop prices in an effort to basically drive out competitors. Then you have in April, Trump intervened. So Trump and the US, who advocate free markets, suddenly backs OPEC to try and fix the price of oil by cutting production. And this was mid-April. There was high-profile commentary saying, a massive cut of, I think it was 10 million barrels a day, or it was a massive cut. It was about 10% of oil production. And so oil prices should have rebounded, but they didn't. And the problem with OPEC is they're cheating. People say they're going to cut, and then they don't. And so my interpretation is that Russia and Saudi Arabia realize that it's in their interest as a low-cost producers to push out higher-cost producers in other developing countries or in other developed countries. And we've actually had negative pricing in some in the US for oil. This is where oil producers are paying people to take their oil. That's really to do with a lack of storage capacity. And really prices are in most countries around that 20 or 25 mark. But that is way too low to support the viability of a lot of higher cost producers. And so the question is it green, is it just oil companies or all energy companies hurting? So here I just yesterday pulled together the stock price of Tesla, which is, we clearly get the crisis and you had this incredible collapse, but it's rebounded. And so Tesla stock has rebounded strongly. In the blue line, we have oil prices, which have have come down nearly 60% from December time. And here we have Exxon, which has been falling for 5 years, in effect, its stock price. And this crisis has cut its share price by about 40%. So this is anecdotal, but in our work on IPOs, we see a similar effect where green IPOs, green stocks have been doing better than brown. So it's not just about oil prices. Underlying this is energy transition. So my interpretation, it feels like the beginning of the end for many high-cost producers in the energy sector. Some of you may question whether low prices are a good idea because it may increase demand, but actually low prices are good from a climate perspective, because it means that firms cannot invest in new extraction, exploration, and so it ultimately reduces capacity. It leads to bankruptcy. So low prices are actually good. Also, an often painted villain is Saudi Arabia, but actually Saudi Arabia, from the US perspective, has helped to stabilize prices, and actually by stabilizing, keeping prices high over the last decade, has facilitated the US shale boom. In other words, has seen its market share contract. So it really wasn't in its interest, and I think it's now finally lost patience. And we're starting to see some shale producers in the US going bust. And I think the tar sands companies in Canada are also going to be in a lot of trouble. Is Trump going to bail this sector out? And I guess this would be, for someone that is supposedly backing markets heavily, then this would be a really unwanted intervention from a climate perspective. So who's going to hurt? Well, there's interesting two narratives. So in the Western media, we often say, well, oil-producing countries are going to hurt because they need high prices to balance their government budgets. But to be honest, Saudi has the ability to borrow. Russia has large reserves. I think the biggest the biggest actor that's going to hurt the most is potentially Western oil firms. And I think there's two key questions from this. Everybody's going to hurt. It's really who's left standing at the end of it, and what impact any bankruptcies might have on the financial system. So going back to the research we're doing on US syndicated loans, where US banks are very exposed to the oil and gas sector. And so really that's everything I wanted to say. So I'm happy to take questions.
Cool, thank you very much, Ivan. It's really interesting to see the development of your centre over time, and well done for all of the hard work you've been doing. And obviously the bit at the end on COVID is incredibly timely and good for us to think about. And on that, our first question from Nicholas Cullen is, why do governments think that big spending is a good strategy during a crisis?
I mean, go back to the 1930s and the Great Depression. So there was one great lesson that was learned from that, where in 1929 we had this massive stock market crashes, and one of the things they did there was they went into austerity, and that caused a Great Depression. I mean, those of you that have read John Steinbeck will understand the nature of that Great Depression. So it's well known that and look, in the GFC, we avoided another Great Depression by easing monetary policy, so having very low interest rate, but also doing stuff on the fiscal stimulus. So so I think that was a success. I think the problem with the GFC is we didn't pull the brake on that early enough, and in a sense we created new asset price bubbles. So yes, I think if you're against that, then do some reading on the 1930s.
Cool, thanks, Ivan. Does anyone else, and Nicholas says thank you. Does anyone else have any questions for Ivan? I'm just looking for any hands up. Oh, here we go. Do you think the high disparity between UNPRI membership and the funds available may be because the firms pledged under UNPRI just want to greenwash and seem green to investors rather than actually invest.
And so UNPRI gets a lot of criticism around this. And actually there's different levels of UNPRI membership. And so what that data shows is anybody that says they're going to take ESG issues into consideration. And so the different bands of membership, and they're subject to greater levels of commitment. And so, yes, you've seen a great number of people, and I agree. I mean, I'm not a big fan of, there are big issues with ESG investing and ESG indices. And yes, I think there is a real issue of greenwashing, but it is evolving. It is evolving. Some investors take it really seriously, are really sophisticated. And again, I would sort of point to NZ Super as a prime example. Some of the bigger ones are really gearing up on this. Some of the smaller institutional investors find it hard to get the expertise. There are differences across geographies. Perhaps unsurprisingly, the US has lagged in terms of considerations in ESG. But it's a fair criticism. But when I looked at, let me go back. You are seeing an evolution, though. It is strengthening, and in the context where governments are worried about, dealing with COVID-type crisis, investors taking this more seriously may be really important. So this distinction between disclosure and risk. I mean, reporting what your Scope 1 and Scope 2 emissions is not difficult. It has a cost, and as I said, it strongly aligns with cutting costs in the firm, which every firm wants to do. Every firm wants to cut its energy costs. In terms of the risk strategy, and we're seeing a lot more of these resolutions, and investors are putting them up in the annual general meeting, and they're going to vote. Sometimes they lose them, sometimes they win them, but they're really challenging the companies. So yes, in that 90 billion, some of it is greenwash, but I think a much more serious issue is around fiduciary duty, the idea that investors have to invest in liquid products.
Cool, thanks Ivan, and thanks Anurag for that question. Colin Campbell has made a comment: although investment markets do look long term, they also discount too highly. Governments will do better. And Sean has asked a question: thoughts about the Planet of Humans documentary, which I have seen coming up quite a bit recently. Is it too negative towards funding of green energy?
Oh, I have to confess, I've been coping with going to online teaching, so I've heard commentary on it, but sorry, I haven't watched it, so I can't comment.
Yeah, I haven't seen it either. Sorry, Sean, it's on my list, but like Ivan, I'm too busy making podcasts at the moment.
I've seen a lot of the people that I respect in this area being quite critical of it. Yeah.
Okay, we've got some more coming. I'll go with bottom question at the moment. Sean, thank you for your smile. Do you think governments should play a role in incentivizing green investment, especially in Kiwisaver funds?
Yeah, look, so I think also going to Colin's point about discount rates, I'm not saying just leave it to the market. Far from it, yeah? Governments have a hugely important role to play. This is something that we've bounced a lot around in the Aotearoa Circle Sustainable Finance Forum. My point is that, governments don't have the money, but governments do have the ability to alter how that money is invested through various mechanisms. So they co-invest. So as soon as you've got a government investing, let's say if they can guarantee bonds or they can insure bonds, they have a huge role to play here. And I'm sorry if I've given the impression that we should all just not worry about government and leave investors to do it. It's far from it. My point is really that investors are taking this increasingly seriously. They are the only ones with the amount of money that we need. But absolutely, government has a huge role to play from even fairly technical issues. So, for instance, banks need to hold capital, equity capital relative to the riskiness of their assets. So governments can change rules on how much capital they hold to encourage green loans. And so this is actually happening in Europe, or there are proposals in Europe where if you are lending to green investment projects, you don't need to hold as much capital as you do if you're lending to oil and gas firms, for instance. So there are rules that you can change that can help a lot with this. Governments can co-invest or provide guarantees for bonds and that sort of thing. So yes, there's a huge role for government.
And the last question, as I'm not seeing many more coming in, and I'm interested to hear your response to this as well. Also from Anurag, do you think that that post-COVID economic crisis or during the crisis, investment into green technologies and green projects will increase?
Look, when this all happened, we sat down with one of my PhD students and we thought, is this bad or is this good for green energy finance? Let me go back to the chart. You know, one of the things when I started, when I was here, so, you know, March, I wonder, oh my goodness, what's going to happen to Tesla? Are we going to start seeing green energy firms going bust? And looking at this and looking at my own analysis with Pia, I don't know if we're going to see increase. I suspect we might see a decrease, but in a relative basis, you're going to see green taking more of a proportion of the investment pot. So actually more recent data has recently come out from the International Renewable Energy Agency, and 75%, I think it was just about 3/4 of all new investment in generating capacity went to renewables. 75%, yeah. So the proportion and the actual absolute number went down, but the proportion in green went up. So I suspect in absolute numbers we may see a decline because, you know, you're not going to start investing in power projects when demand is falling off a cliff. Yeah, you're going to find it difficult to find investors, but the proportion of green will continue to rise.
Great. I think that's an awesome comment to leave on. Thanks, Ivan. And thank you very much for today. I know we can't all clap, but I'm sure we all are in our own way. That's the one downside of Zoom, isn't it? That you can't hear the appreciation that we have. But we really do appreciate your time today. As I said, it's interesting and a really important understanding in terms of climate change to understand the financial background and implications of various different actions and activities that are occurring. So I thank you very much today, Ivan, for taking the time to talk to us. And no, sorry, there's things coming through now, but there's various different things on the comments as well, still popping through, but there's lots of thanks coming through from people. So I hope you all continue to have a good day in your bubbles. We will, the Kaupapa Hononga will be having another talk in the near future, and we'll get in touch with you about that. So thank you all.
Fantastic. Cool. Thank you very much. And if anybody has any follow-ons, happy if people email me. I've got an unusual surname, so very easy to find on the net.